Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Hello and welcome to this episode of the Australian Finance Podcast. I'm joined as always by my co-host, Gemma Mitchell. How you doing?
I'm great. Thanks, Owen. How are you?
Pretty good. Author of The Money Reset, is it?
It definitely is. The Money Reset, yes.
The Money Reset, yes. In all good bookstores very soon. So there it is. Check it out. Gemma Mitchell, The Money Reset. It's a blue book for people that are listening with white font and a little bit of splash of orange on there. So check it out. It will be in bookstores soon, right? Because it's Wiley.
It will be, yes. It'll be in bookstores and every airport under the sun next week after.
Wow.
2 weeks to go.
You know what? I'm going to start sending you photos whenever I'm at the airport and I see The Money Reset. I'm going to be like, oh, there it is right there.
Oh, I'm going to do that. I'm probably just going to start walking around to shops and taking photos. And maybe if a shop doesn't have it, I'll just take my own and pretend.
Oh, I like it. What have you been, other than us unashamedly promoting the book, what's been on your agenda? What's been in your calendar this week?
Lots of promos. We've been getting lots of great questions come through because I've been putting it all over socials and linking the podcast questions, like the link to where people can send questions in. So we're getting some really good stuff come through. And another shameless plug for the book, anyone that sends a question in August goes in the draw to win one of 5 copies. So hopefully that's why they're all flooding through because everybody wants one. But yeah, just lots of social stuff. We had a rate cut this week.
Interest rate cut, that's big news.
So we did some like blogs and content around that. But yeah, just kind of ticking along.
Yeah, big news actually, the RBA rate cut for a lot of Aussies that have a mortgage. This one was a somewhat modest cut, but there is a belief that interest rates will still fall throughout the year. We're not sure when exactly, but before the end of the year, what we say in finance is the market is pricing it in, which basically means that investors expect that rates could fall. It's not always the case that it will, but by the looks of it, we could get another cut before the end of the year. So that's great news for anyone that's got a mortgage, may even provide some rental relief for people because the landlord's not copping all that interest as well. So good news across the board. Final thing on that, falling interest rates, would you believe it, are actually good for stocks. So makes people want to invest more, which is good.
Gives them a bit of confidence, also some surplus money in their budgets potentially so that they can actually be putting money into the market. Not ideal for people with savings accounts, I guess, and that's why investing over the long term is so important. But yeah, can really have a knock-on effect there, and it's just so important that you're aware of what rate you've got and what your bank's doing with it, and if they're passing on rate cuts or if they're not, and all of that type of stuff. Loyalty is where you really pay the price with falling interest rates and rising interest rates as well. So yeah, you want to be checking on these things pretty regularly, whether it's your mortgage or you've got a savings account.
Yeah. That's a great point. In the world of ETFs, which a lot of us are in, there are 2 big ETF launches in the past week, I would say. We've got the new ETF from GlobalX, which is A300. There's been a lot of community discussion about this. A300 is basically a doppelganger for VAS, just lower fee. That's not me saying to go and invest in it, just a good comparison to make. So A300 from GlobalX. GlobalX is a sponsor of our Investors Podcast, FYI people. The other big ETF launch this week was HYLD from BetaShares, which is a sponsor of this podcast.
Yes, I did see that.
So HYLD is basically a doppelganger for VHY from Vanguard. So Vanguard's facing competition from all angles, which I think is great for consumers for what it's worth. It's not a doppelganger, I shouldn't say that. HYLD, there's an episode coming out in the next week, Gemma, with Cameron Gleeson from BetaShares. We talked all about it because we own both VAS and VHY at Rask. So we recommend and own those 2 ETFs. And so these 2 new ETFs are very fierce competitors to those 2. So anytime that happens, I really pay attention. But yeah, HYLD, it's a dividend ETF. It pays monthly income, which is quite interesting. It doesn't hold the 70 stocks that VHY holds, but it does hold about 50 odd, and it has a few different rules in the mix in there. So Cameron and I talk about that all. I think that's on Monday's episode, everyone. So if you're interested in dividend income, Monday's episode is the one for you. We do bobble up and down from technical to non-technical talk in that episode, but it's a good one to stretch your understanding of how ETFs are built. So that's out in the next week. We've got the book giveaway if you send in your questions, and we've got some crackers today, Gem.
Yes, we certainly do. But as always, we want everyone to make sure that they understand that everything we talk about today, we might talk about products like we already have, ETFs and different things, strategies. This is all for information, education purposes. We don't know your circumstances, your goals, your objectives. So personal advice might be needed, but just take this for what it is, factual, education, general, and always do your own research to make sure it's appropriate for you.
Yes, absolutely. You can read more about what that means by heading to www.rask.com.au/FSG. That's our financial services guide. That tells you all about the different stuff that we do, as well as general advice, factual information, and personal advice and the differences. Cool. How do you want to tackle these questions, Jim?
Do you want to ask?
Sure. We've got Low Rate Lucy who wrote in, should I be doing anything with the new interest rate drop? This is a fantastic question. They go on to say, will my rate automatically change? So, Gem, interest rates have come down from the RBA. That's the big one that sets the interest rates. Does the bank have to pass it on for me?
Absolutely not. So they feel a lot of pressure. So they feel pressure from the media, consumers, but they don't actually get their money from the RBA. So they don't have to pass on that rate, but they feel a lot of pressure too. So they might pass it on in full, in portion. And if they do pass it on, they might say, well, we're passing it on in a few weeks' time. So they're usually pretty quick to announce what they're doing so that everyone leaves them alone, but they're pretty slow to implement, I would say, very generally speaking. Now, if you're on a variable rate loan and they pass on a rate cut, you will get that implemented whenever they say it comes into effect. If you're on a fixed rate loan, it won't impact you because you've signed a contract that this is your rate for this amount of time, regardless of what's happening with rate changes. So you need to get in contact. Your bank will be reaching out to you, probably via an app, via your email, a letter in the mail, but you can just jump on and see, like online, and see what they're saying they're going to be doing with the rate. You could give them a call. But yeah, chances are if it's a variable rate, they pass it on, it'll be happening in the next couple of weeks.
Yeah, which is good news because if you've got a big mortgage, saving 0.2 or 0.25% on a big loan is really good for you. So
it can have a massive impact. Really, now, there's actually a couple of other instances here. So if you're on the minimum repayment and your bank passes on the rate drop, usually you'll get a letter saying, this is your new repayment. They may, depending on how it's set up, they may actually pass on the rate drop, but your repayment might stay the same because you might be on a repayment kind of contract. That would just mean that you would have to say to them, hey, can you adjust it? Or if you keep it the same, it means that more of that actual repayment is going off your principal and less is going to interest. So they might not actually automatically drop the payment, but you would still be getting the interest rate benefit in that case. So it's really different between every single bank and what type of loan you've got, but getting in contact with them is really important. And then, working out what you want to do with that difference is the fun part. Do you want to pretend it didn't happen and keep putting it on there so you're getting ahead of your loan? Do you, does it have to go to another priority in your life? Is it going to help your cash flow?
It's just, as you say, be intentional with it. The one thing to keep in mind is you could put, instead of paying down the mortgage straight away, you could just put that extra amount in your offset account if you've got one of those set up by your broker. And so you can have an offset account. So it has the same effect as paying off the mortgage early. The difference is that you've got access to the money if you do need it. I always think that, interest rates come and go. And if you were coping under that interest rate setting, maybe just use that money really effectively now. If you don't need the money, don't let lifestyle inflate to your new budget. Like that's what we call lifestyle inflation. It's not a great thing.
Yeah, so this was the issue when, like I saw with a lot of people, when interest rates were 1.9, 2%, they were like, oh, this is so cheap, so we can inflate our lifestyle in other areas. Instead of the attitude with money is so cheap right now, let's pay it back while it is so cheap, which would have been a very smart attitude to have for future you. But, you know, myself included, I was just like, oh, I'm just loving this break, you know, like these really low interest rates. But yes, interest rate drops, if you've already factored it in and you're coping okay, might be a good opportunity to create a bit of breathing room and a bit of a buffer and get ahead on some loans, or it might be realistically that has to go to another job in your finances.
Absolutely. Good question from Low Rate Lucy. Frugal Farmer writes the next question in. I like that name. How does someone invest in a company prior to its IPO? So just for people's context, an IPO is when a company first releases its shares onto the stock market, and you'll hear a bit of a buzz about it, and they'll be in the media and all those types of things. Like a good one recently was Guzman y Gomez, which is GYG, the fast food joint. That was a big one recently that you might be familiar with. So
I should have shares in that based on how much I go to that place.
You Queenslanders, honestly, you Queenslanders love your GYG. We've got some here in Victoria and Melbourne. Sydney's got quite a few, but you Queenslanders, this one, I reckon it's as common as Macca's every time I drive up and down the coast in Queensland. It's crazy.
They're everywhere.
Yeah. But how do you do it? Do you ever do it?
So I've been involved in some capital raises, and some crowdfunding, like Birchall and stuff like that. But I don't do it. No, I would say it's part of my satellite, but not my core. And when I do this, not that investing is gambling, but I would more put it in my gambling I'm comfortable with. I would put things in that I'm okay with losing. Yeah, so it's very much a satellite approach for me. But this one, I thought you will absolutely know way more than me. But my initial thoughts were, you're already involved with the company, so you know what's happening. You know, you've contracted for them, you've worked for them. Usually that's how you find out about these things and get like an offer to invest, like that, you know, and then a cap raise and stuff.
There's a few different ways to go about it. So most people are aware that you can buy and sell shares online, but there's still a massive part of the Australian finance community, which is you have a physical broker, like a person that you deal with. So say like Pearler, which is sponsor of the show. Pearler is a brokerage platform, right? But before brokerage platforms, there were brokers who were physical people that you would go and meet with and they would buy the shares. Those people still exist. Common names include like Morgans would be a good one, Hartley's, these types of names, Bell Potter. These are big finance brands. And basically it's where all the fancy people might go to buy some shares, but less and less so. And if you're part of that community, typically what happens is you can get an offer to participate in an IPO. And so say, for example, Guzman, like GYG, is coming onto the stock exchange. I don't know what the share price is, but imagine it was $20. If you buy it in the IPO, you might get it for like $20 exactly. But if you wait for it to get to the stock market and it jumps to $22, then obviously you're paying more. So some people want that access, that early access. So you kind of need to be a client of those brokers. Another thing to keep in mind, however, though, is that many of the online platforms, I don't think CommSec does this as much. Maybe they do. I know they do it for part of their CommSec accounts, but the big brokerage platforms now offer access to IPOs, Gem. The thing to keep in mind, and this is for everyone to listen up really closely to this, is that if you're getting access to the IPO, it means that someone else passed on it. So I don't mean to be rude to myself, to you, Gem, and everyone listening to the show, but we're pretty small fry, right? If one of these big companies like GYG has now offering everyone shares, chances are it's because the big investment companies didn't want it. And so why didn't they want it, right? So really keep your wits about you. Not every IPO is a good one. That's what I'll say. But typically you get it by being part of one of those brokers. Fund managers can also, will also use them as well. Fund managers love to invest in pre-IPO companies. So that's the answer to that one. A bit technical, but it's a good question. The next question comes from Hannah. I'm pretty sure that's a fake name, but we'll just assume we'll assume it's real. So Hannah writes in and says, is it better to invest as a couple or separately, like as individuals? What do you think, Gemma?
There is so much to this question. Absolutely. It really depends. Yeah. And this is what so many people are considering. Like this is a really, really common thing. So it really depends on like as a financial advisor, if they were going to answer this, they'd be looking at what are your goals? How much are you investing? What are your taxable incomes? Are you on similar taxable incomes? Is one significantly lower or significantly higher? How might that change in the next few years? Like, how long have you been together and what's the I don't want to say likelihood of this relationship, but you know what I mean? Like, how early is it? There's so much to consider here. But the tax one is a huge one. So for example, when I was married, before we had our structures and stuff in place, like companies and trusts and whatever, we would always invest in my husband's name because he was the lower taxable income earner. And so it was our money, it was family money, but it just made sense for us in that perspective. And it looked as if that trajectory would always kind of go. Whereas some people we talk to, they'll like for advice clients, they'll be like, oh, well, right now, maybe my wife or my husband is off work. And so it's better now, but within 2, 3, 5 years, we'll be even. And so that you wouldn't really consider that kind of strategy then. So you kind of want to think initially now, but long-term where you want to go. But it really comes down to your goals. What are you comfortable with? And I'm big on, you can be working towards the same goals. If that's saving for a house, saving for a holiday, investing for your future, retirement, and have separate stuff. Like you can be working towards the same goal and keep things completely separate.
I think you answered that really well. As Charlie Munger famously said during all of those annual investor meetups with Warren Buffett, I have nothing to add. But actually, I do. No, it's just a
you
tiny
always
thing.
have something to add.
There's a tiny little thing here, which is that I'll tell you where people go wrong. So you can invest in your own name. You can invest in as a couple. You can invest in his, hers, or whatever the combination is. You invest in all those different tax structures. But when it comes to property, pay very close attention to the difference between tenants in common and joint tenancy. So you can buy a property and it's kind of like, just imagine a number between 0 and 100 or 1 and 100. You can nominate who owns what percentage of that property. This is really important to understand because a property investment is a big deal and it will incur capital gains tax when you sell it. So structuring that one correctly is really important. And if you've never heard us talk about tenants in common or joint tenancy, it's okay. People get confused all the time. But please get tax advice or financial advice on this before you buy a property, because I've seen it recently where it's typically the first 1 or 2 properties that people might buy. They get it wrong and then they're like, oh my God, I didn't know you could do that. So that would be one thing to keep in mind.
Yes, I absolutely love that because that's from a couple of different perspectives. Maybe you're coming in with different resources initially and you want to draw a line in the sand. Maybe it's because if it's tenants in common, you're kind of like separate owners of your position, and that like you put it in your estate, your will, that, hey, if I pass away, that part that I own goes to my estate and whoever I want. Whereas if you're the joint tenants, which is the most common one, it's like, hey, no, we own it together. It doesn't really matter. If I die, it goes to them. And you can't really separate it kind of out and go, well, no, somebody like my kids now own that share. So this is really important, why you need a conveyancer, good tax account, all that kind of stuff. But yeah, sorry, Hannah, we absolutely can't answer, but there is so much to consider. And I think you just need to get really clear on your goals, your taxable income now, so what makes sense, but also what you want this investment to be, its size, where your taxable incomes might be in 5, 10 years.
Yep,
that will be a good starting point.
Yep, well said. Email me, please. That's their name.
I did actually email them too. I was like, hey, your neighbours email me, so I'm just emailing.
Well, it's a good name and it got our attention. So email me, please. They say, I'm in my 40s, new to Australia. What should be my strategy to increase super? Now, you're our resident super guru, Gemma. So what would you do? You're new to Australia, in your 40s, general obviously, but what are some of the tips and tricks people can keep in mind?
I absolutely love this, that it's even on their radar. So the best things that you can do is learn about super, engage with it, and you're in your 40s and you're already thinking about it, which is great. So this is something that the earlier that you get started, and 40s is perfect. This is not something that you want to be on that learning curve at 55, 60. So I love that you're already thinking about it. I would work out where your superannuation is right now. Work might have set you up with one. Just engage with your super fund. They might have intra-fund advice where you can just chat to an advisor, ask them about contributions, investment allocation, that kind of stuff. I would just get really clear on the understanding of that, what free resources they have. We've got lots of free info, and I'm going to email it to you as well. Just starting the learning, so important. And then one of my biggest hacks, which I want everybody to do, everybody should do this, is have a reminder in their calendar for June 1st every single year. So June 1st, we still have 30 days of the financial year. Once the financial year is done, you can't do anything to add money to super. It might be that you are going to be under the low income threshold for the government co-contribution, and you might have the ability to chuck $1,000 in and get 500 co-contribution or something. But checking in on your super, what you've earned for the 11 months of the year, and still have a whole month to maybe change something, add something, I think is a really, really good time. So I think that's a little hack to check your super 1st of June every year. Don't wait till the new financial year. I would do that. And we actually have, so this particular person, I'll send you the link, but for anybody else, we're doing a segment in the Ladies Finance Club Wealth Summit coming up, and it's add 100,000 to your super. So this one will be perfect for you because I've just finished like the slides and stuff for it, and we're doing an example of what to do in your 30s, what to do in your 40s, and what to do in your 50s if you want to add 100,000 to your retirement. And it's like fees, performance, stuff like that. So this one will be great for you. It's online, it's free, and I'll put it in the show notes for everybody, but I will also email you too.
Yes, email me please. Great question. We are doing that Ladies Finance Club event, free event, as Gem said, just to reiterate that. You can come along. Gemma and I will be speaking. I think our topic is how to get an extra $100,000 from super
retirement.
By retirement, yeah.
For retirement,
For retirement. We've got some good tips. I think you can get a lot more than $100,000 if you follow the tips. So come along and check that out. It is great that they're really checking in in their 40s on super, because that gives them, a good 10 to 15 years, 20 to 25 years to compound their wealth, which is absolutely fantastic. I will add one thing here. I love your idea of the June 1st check-in. And the reason is for younger people too. If you're using the First Home Super Saver scheme, which is the one where you can contribute, I think it's $15,000 a year, up to $50,000 in total per person to save for a property. Remember that what we talk about is that even though we're on the 1st of June, right? And then at the end of that month, the 30th of June is when the tax year ends, and you can't, go back and put money in back in time, right? You got to do it by June 30. There's a really important thing you need to understand here, everyone, which is that it takes a few days for the super fund to process your money. So even if you sent it on June 30th, it might not land in the super fund until after June 30. So making sure that you're contributing the money like on the 21st, or that some super funds say the 25th, or some would say earlier. So making sure that you set that reminder on June 1st is a really good idea, Gem. So thanks for that one.
They all have very different cutoff dates, but I always go around the 20th, take some action, 25th if you're wanting to, if you want to live on the edge.
Yeah.
But don't do it on the 30th.
Yeah, fair enough. Mama be flippin' has written in. Hello. This is probably my favorite question of the day. I'm not going to lie.
I'm loving this one. This is right up my alley.
This is the final question for today. Mama be flippin'. They say, hello, I'm selling items from hard rubbish and unclaimed storage. This is like one of those pickers shows, where they go and they bid on the unclaimed storage.
The storage sheds, and then they see if they're I love
cool
that.
Stuff
I
in
love
there.
that stuff.
Most people that put stuff in storage, it actually is valuable, because otherwise they wouldn't put it in storage, right? So it's
I think
such
that's
a good
the
idea.
premise of the show. But you have to know what's valuable or not, and there's so much junk in there. You have to have like an
X-ray
eye for,
eyes. You have to look through everything. So anyway, I'm selling items from hard rubbish and unclaimed storage. It is a little extra cash to help me invest, and I love this bit, and fund fun as a single mama. Currently making around $3,000 in a year, I believe it is currently classified as a hobby, and I don't have to declare it. But I don't really understand where the line is between hobby and declarable side hustle. Can you help explain? So they're getting a bit of this cash, $3,000. Sounds like they're doing it regularly, Gem.
Yeah.
So what are your thoughts?
This is a hard one. So I love a furniture flip. Like I am very much a DIYer. But I used to do that more when I had actual time, and I would consider that a hobby because you don't know if you're going to make money out of it. You're doing it because you really enjoy doing the manual labor and all that kind of stuff of it. But this one is a little bit different because it's potentially not putting anything into it that you're getting personal enjoyment. There's a fine line. So you're going to ask an accountant this question, Mama be flipping, but really what a hobby is classed as, because some people sell like flip cars, like and call that a hobby. So it's for personal enjoyment with no real intention of making a profit, but or run as a business. You haven't like started intentionally like stocking up, getting stock and different things. So this is where the unclaimed storage, I think maybe, but I don't know, because it's kind of like fossicking, isn't it? Like if you took a metal detector down on the beach, I wouldn't call that a business. Oh, actually I paid a metal detector guy. So
Really?
Remember when I lost my ring?
Oh, yeah, you lost your ring. Yeah.
He was a legit business. So no, that was a terrible example.
No, but if you're DIYing your own, you just go and look it on the sand or whatever.
And it's it's a hobby. Yeah, it's such a fine line. It has to be your intention. If you're setting up like a marketplace stall, like Facebook page, Instagram page, I would say that's crossing the line. That's a business. You've got business intentions.
Yeah. It's
a hard one.
The more I looked into this, the more I realized that it's a very big gray area for the ATO, because they want people to be able to say, go and sell a painting that they no longer want, right, on Marketplace, or like go and, do something that just happens to get them money. Like we want to encourage people to be able to do that. But I think you're right. Like there were a few kind of lenses at which the ATO looked at it. One of the ways is kind of, and I kind of alluded to this when I said it sounds regular. So if this is a business like a going concern, like you're doing it for a profit, as you said, Jem, regularly, like you're repeating that process, it looks like a business, that would then mean in the ATO's eyes, they have structure to it. And the structure is the key phrase there, because if you've got the structure of a normal business, you look like a business, you sound like a business, you quack like a business, they're going to be like, well, it is a side hustle. But if you're just like a once-off, willy-nilly thing, I think there might also be some exemptions for those cars that you mentioned before, by the way. But we're not accountants, but by the sounds of what's happening here, it might be worth declaring just to be on the safe side. And hopefully the $3,000 a year is not that material in terms of tax. I think it's absolutely wonderful thing to do. I know some people that flip furniture, as you were saying, and they do it so well. They love it. They love the creativity of it. And they just happen to make a fair bit of money. We've bought some of that furniture from them, to be honest, multiple times. That's what we tend to do most often, to be honest.
Yeah, it was like a not full time, but ATO don't listen. It was like a hobby for me for a while. I was like financial planner by day, flip furniture by night. But I love this idea, and I don't want you to be scared of paying tax. So if this is actually working and it's bringing you in money, that's okay to call it a business and actually put it through, like get an ABN, put it through your tax. Like you shouldn't be scared of it. If this can make you money and fund fun as a single mama, like let's lean into it and God, let's make it a business. Like we shouldn't be scared of paying tax if it's bringing you money. And let's do it.
Yeah. So the downside is you pay tax and you might get an ABN, which is like $50 or something. It's not that bad. But the upside is that you'll feel way more confident in running it, right? Because you know it's legit, right? Like you're like, oh, well, it's legit. I'll just go for it. And that can be really liberating too. And I think I would love to hear from Mama Be Flippin' if she's got the willingness to write back in again and tell us what's like one thing that she's got from like a storage container, or like,
the best.
The best like thing that she's flipped. Like I would love to. I used to love. There used to be a show. I don't know if it's still a thing. It's called Aussie Pickers, and they used to go around all these rural garages and sheds and just ask people if they can look through and buy stuff from them, just in these old sheds. And the stuff they would find would be incredible. So I'm always like treasure hunting. So love to hear from your Mama Be Flippin'. It's a really cool thing. Okay, so let's recap today's episode. The RBA has cut its interest rates. Check your bank to make sure that they're passing it on. If not, get all of your friends and family to call the bank at the same time and overwhelm their customer support. So then they're forced to do something about it. They can pass it on. Number 2 is there are 2 new ETFs that everyone should probably be on the lookout for. A300 from Global X and HYLD from BetaShares. Both really interesting ETFs. We're going to do a bit of work on them in the next couple of weeks for our own internal purposes as well. If you write in a question using the link in your podcast player in the YouTube description, you go in the draw to win one of Gemma's books, which I believe is called The Money Reset. There we go. Yeah, The Money Reset. Had to stretch for that one, Gem.
Oh, yeah. Because you've read it so many times.
Well, it's just out here in the. I've got it. I've got no excuse now, don't I? We've had some great questions from Low Rate Lucy, who asked about the interest rate drop. Yeah, the banks don't have to pass it on. Frugal Farmer asked about investing in an IPO or initial public offering. It can be pretty tempting. I don't want to say that it's like compelling. You can just wait till the shares are on the market and just buy them on the day or buy them the next day. Never be in a rush to make an investment is my honest opinion. Hannah wrote in and said, better to invest as a couple or separate. It's all about those goals, Gemma said. Email me, please. Okay, says Gemma. Boosting your super, there's a free event coming up, Ladies Finance Club. We're very grateful to be part of it. I think there's like thousands of people have registered. So will be a great session. There'll be Q&A on the day. And you just do it online. You can just tune in while you're working from home. As in the state of Victoria, basically that means everyone can work from home 24/7. Mama be flippin'. You got an awesome little business there. Keep it going. Maybe speak to your accountant if you need to register for an ABN or something like that and declare
Business/hobby, we can't confirm.
Yes, amazing hobby. Yes, that's what I needed to say. Sorry, Gem. So absolutely wonderful Q&A session today. We hope you enjoyed it. Don't forget, you can leave us feedback using that Q&A link as well, or just on social media, YouTube, even Spotify. So get in touch. We'd love to hear from you. Gemma, author of The Money Reset. There we go. Get one more time. Thank you for taking the time to join me today. I really appreciate it.
Thank you. I'll see you in the studio in Melbourne next week for this Q&A.
Looking forward to it. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.